The monthly CPI from the Bureau of Statistics shows that over the 12 months to August, we have seen inflation tick up just a little bit to a reading of 3% over that 12-month period from 2.8% in the previous month. Now, what is interesting about this is that we did see various things lead to that increase. The largest contributors were housing, food and non-alcoholic beverages, and alcohol and tobacco. And there's also an electricity component to this as well. We will bring in KPMG's chief economist, Dr. Brendan Rynne, now. Brendan Rynne, thank you for your time.
Hi, Lisa.
How significant is this data for the RBA, do you think?
Look, I don't think it's all that important in terms of making key decisions. I know that we've got the RBA meeting coming up at the end of this month. I think that certainly most economists, and me included, did think that the Reserve Bank was going to sit on its hands this month, but certainly for November, that it's really a live meeting in relation to looking to cut the cash rate further if the data supports that. Now, I think the other thing we know from the Reserve Bank is that they're very much focused on the quarterly CPI data. We know that that quarterly CPI data for the September quarter will be out at the end of October, just ahead of the early November meeting for the Reserve Bank. So I think that really the quarterly CPI data is going to be much more important than what we're seeing today. But nonetheless, it still provides bits of information, and more information is better than less information. So, but on the whole, I still think we'll wait to see the Reserve Bank more in play in the November meeting than the next one at the end of September.
And as you point to, this monthly series is quite volatile. The market and economists got quite excited at the end of June when we got the monthly CPI, which showed the headline rate had fallen to 1.9%. And of course, the RBA, as you rightly indicated, looked through that. So given that we're back at 3%, is it the case that they will be looking through that? But it does seem as though inflation is heading in the wrong direction.
It does, and I think what we always knew was that the headline CPI, the data, was always going to be muddied by these electricity rebates. And what we've seen is headline CPI that's been probably pushed artificially low because of the electricity rebates, and that's why we've been really focusing on trim mean or core inflation. We can see that the trim mean or core inflation has actually fallen during the month from 2.7% down to 2.6%. Largely, that's got to do with the fact that electricity prices on a month-to-month basis fell by 6.3%. Largely, that was, again, a timing issue, having to look at when the last electricity rebates actually were paid. They didn't get paid in July, they got paid in August. So what you saw was that electricity prices in July went up quite substantially. I'm just searching for the figure. And what you then saw, yes, it went up 13.5% in July, but then fell 6.3% in August. So this volatility in electricity prices has really got to do with when these electricity rebate payments actually occur. And once these stop at the end of the year, we'll have a much normal reading on a month-to-month basis with headline CPI, but which all it means is that we're really relying on that trim mean or core inflation to give us a better sense of what's happening.
Earlier this week, the Governor, Michelle Bullock, spoke at an event and sounded a bit more hawkish, less likely to cut interest rates. Is that a risk now that we will get less cuts or even no cuts from the RBA this year?
I don't think that's the case. I still think that what we're seeing is a relatively weak overall macroeconomic environment. We still need to see more investment activity happening within this country, and helping to stimulate that economic growth will be a cut in the cash rate going forward. It's still slightly contractionary. We think that the neutral rate, or the Goldilocks rate of the interest rate, neither too hot nor too cold, is probably about 3%. So bringing the cash rate down much closer to that number is really ideally where the Reserve Bank should be heading. And we've still got a couple of cuts to achieve that. The likelihood, though, is that there will be one more this year, probably in November, and certainly one and possibly two in the first quarter or in maybe the first half of next year to bring us back closer to that neutral rate. We're still relying too heavily on government spending. We do need to see that the private side of the Australian economy step up a gear, and helping them achieve that will be further cuts in interest rates to provide a more stimulatory environment.